Hello and welcome to this edition of the video market update from Orbex.com. We had somehow another boring week last week with lack of fundamentals across the board, yet volatility also spiked up once again from middle of last week until late Friday. Of course, thanks to the central bankers around the world who basically was behind the spike in volatility, as it seems that they are all on the same page once again. The most important headlines that we had last week that hit the market across the board was that the easy monetary policy era is coming to an end, maybe even sooner than even later. There were also some reports saying that the Federal Reserve will start unwinding its balance sheet as early as September. In the UK, the Bank of England Governor Mark Carney also hinted for a possible decrease of the ongoing asset purchases as inflation is much higher than the central bank's target. In Europe as well, the ECB President Mario Draghi gave the market some confusing remarks about the ongoing QE, saying that it's still very needed or still needed with lower interest rate to support growth. But at the same time, the ECB decided or announced that also a day after these comments, saying that the market misjudged Draghi's comments. The remarks about the central banker spiked the fears across the board again, leading the global equities to close the week in red. But at the same time, and most importantly, the global bond yields posted one of the biggest days or the biggest daily increase this year. The US dollar index also, despite all of the reports about the possible normalization by the Federal Reserve in September, it also failed to break higher and tumbled back to the lowest level since October and closed the week's trading, last week's trading, below 96 barrier, which keeps the bearish outlook unchanged. Where do we go from here? Well, since the central bankers right now are on the same page and looking to end the easy monetary policies, this would bring back the fears toward the bond market, and this is one of the reasons why the bond yield spiked last week. The global central bankers has been pressuring the bond yields across the board and pressuring the bond yields lower since the financial crisis until today. The question remains now, what happens when they lift these policies? And of course, the bond yield would likely to be much higher, but they will have to fight to manage such rise in yields. Otherwise, the bond bubble is likely to pop sooner or later. As for the week ahead, there are also some economic figures and events which may have a notable impact on the market, but there are also some days off, especially also in some countries, such as Canada on Monday and the 4th of July in the US on Tuesday. Yet, volatility is likely to remain also on the rise. On Monday, eyes will be on the manufacturing PMIs across the board. On Tuesday, we will be watching Australia's, or in Asia, beginning with Asia, Australia's retail sales and the RBA decision will be released on that day, which is likely to remain unchanged, if that's from the Reserve Bank of Australia point of view. But I would suspect a verbal intervention by the Reserve Bank of Australia to pressure the Aussie once again. In Europe, we'll be watching also the Spanish unemployment rate or the unemployment report and the UK construction PMI. Wednesday is all about the services PMIs in addition to the FOMC meeting minutes, which might be a non-event unless if it comes with a surprise. On Thursday also, nothing much from Asia and even Europe, but during the US session, eyes will be on the ADP non-farm employment change. We have the building permits, a trade balance deficit, ISM non-manufacturing PMI, and finally the crude oil inventories. Finally, on Friday, what's likely to be the biggest day of this week, eyes first of all will be on the G20 meetings, but most importantly, we will be all watching the US jobs report, which is likely to have the biggest impact on the market this week, especially if it comes with another surprise to the downside. This is it for the fundamental side of this video. Now, let's have a look at our usual technical charts. Beginning with the US dollar index as always, and as I said at the beginning of the video, the US dollar index again failed to break higher and tumbled all the way back down below the 96.50s. We broke even below the 96 and continues all the way down to 95.62 at the end of last week. And this was again due to many of the events that happened last week, especially the central bankers' remarks. But the failure of the US dollar to manage to make a slight retracement to the upside, that would give us it's giving us a lot of hints that the downtrend is getting deeper and deeper and even stronger right now, especially that the two moving average, which is the 100 and the 50 and the 100, is now below the 200-day moving average, which should be watched very closely. This is called the death cross, which means that the medium-term outlook is now on the downside more than even the upside. However, for the next week, we will be looking for a very short-term retracement. Actually, I don't think so that if the US dollar managed to rally for a short-term retracement, I don't think so it would last above the 96.52 once again, because it was a solid support, and then it was very weak once we broke it below that. So I guess so any kind of like retracement to the upside is likely to be very limited for the US dollar below the 96.50s. Going forward also to one of the most important charts that we've been talking about a long time ago, the Kiwi. The Kiwi finally made it for more than almost 8 weeks of gains. However, last week we broke above the 90 or the 73, but at the same time we are still within the same area that the Kiwi has been trading within, or since July of last year. Such move would still require the bank or the bank of the Reserve Bank of New Zealand to intervene once again, maybe in the next few days, not through verbal intervention, but might be actually an actual intervention in the currency market. However, the technical indicators are still supporting us, which means they're still heavily overbought on most time frames, which basically still keeps the possibility for a short opportunity around the current levels. I would suggest like to put a stop above the this year's high, which is January's high, which is around like almost 73, 74. So keep an eye on this one. I would still be short unless if it breaks higher or above the recent highs, which is or this year's high. By then I would change the outlook, but otherwise I'm gonna still short for the next few weeks. The Aussie has the same story, but finally the Aussie made it also to the same area or the same selling zone that we've been in since March of 2016. That's a year and almost like 3 months since then until today. That will keep us also from buying this pair for the time being. I would still suggest shorting it below the current level, which is 77.20s or even 76.90s, with a stop above the high of this year, which is also around the one that we had in March, which is around, we're talking about like 77.50. That'll be our stop before before another decline all the way back to 50 days moving average. Going into the euro. The euro made another clear break last week, especially after it tested the trend line here for the past few weeks. The most important thing also, we have a golden cross in the euro, which is very clear right now. The 50 and the 100-day moving average is above the 200-day moving average, and the 200-day moving average is starting to pick up again. However, after last week close, we still need to see some sort of a retracement to the downside, possibly toward 1350s, 1360s before the upside trend resumes. The most important level that you have to keep an eye on is the 114.60s and the 115, which is the psychological resistance, especially that the technical indicators are heavily overbought on most time frames. That's why we still need some sort of a retracement before the trend resume. But don't start to buy the euro while it's at the highest level since 2016, April 2016. The British pound also made a very interesting move last week after reaching the 100-day moving average multiple times, and then it actually breaks all the way back higher. This was on the back of many factors. First of all, inflation data are still rising. Inflation data is still rising. At the same time, what was said by the Reserve Bank, by the Bank of England, Governor Mark Carney, about to decrease the pace of the QE right now, this would give a very important push to the British pound. In addition to that, also the British Prime Minister Theresa May also said that she might even withdraw from the negotiations about the Brexit. This would mean that there is still a possibility for the UK to stay within the EU in the next few years. This is only if the UK decided to withdraw from the negotiations. However, 130, that was a very clear close last week above the 130. However, we still need the 130.40 to be broken. When this happens, 130.75 would be our next target. But at the same time, keep in mind that technical indicators are heavily overbought. That's why I still believe that we might see also a retracement in some of the currencies in the next few days or this week before the US dollar downtrend resume. The dollar yen also made a very interesting move actually last week, and it actually tested the downtrend on the daily chart. That's one thing. At the same time, there's many confluence levels, or it's actually right now confluencing with many levels. First of all, the trend line, which was tested on a Thursday around 1279. It failed to break above that resistance and came back down. At the same time, it was supported by the 100-day moving average, and most of the moving average right now are crossing to the upside a little bit. But keep in mind that you have a 61.8% Fibonacci here on the daily chart, which is still, I still believe there is still a possibility for another decline or another leg lower. Technical indicators are still also supporting us with such with this view. So keep an eye on this. As long as it stays below the 114.33, the bearish outlook is here to stay. Finally, about gold and silver, nothing much this week. We stayed within the same levels from last week, within the 50 and the 200-day moving average, up and down. But this is still some sort of like a little bit disappointing. But I still believe that gold still has some potential in the next few weeks. Again, the tensions around the world is likely maybe to escalate more, especially with North Korea and also what's happening in Iran and Turkey right now. So this would still keep the possibility for a higher gold in the next few weeks, in the next few months. Therefore, I'm still going to be bullish on gold as long as we are above the previous bottom, which is 1214. So that's the gold. Finally, silver. Silver again, it failed to prove itself. Right now things are turning much lower and even worse, which is I still also believe at the same time that silver might rise at some point, but for the time being, technicals are not even suggesting any sort of like a rally for the time being, especially that the 50-day 100 and the 200 right now is crossing to the downside and they're turning lower. This is where it put silver at risk to retest the bottom here, which is around $16.05. So I'm not going to touch the silver anytime soon, but I would still going to be watching it if it's going to break the previous bottom or no. This is it for the week. Thank you for watching this week's video. Please subscribe and like and share Orbex channels to get the latest support in the latest videos. Also, if you have any questions, please leave them below this video on YouTube, and I will try to answer them as soon as I can. Thank you for watching. I'll see you once again next week. Have a good one.